Welcome back to Ellison Capital TV. I am Shade, and if you're passionate about learning about real estate, multifamily building specifically, building sustainable cash flow, and structuring deals like a pro, you are in the right place. Today, we are unpacking a topic that sounds very technical, but it's at the heart of every deal we do here at Ellison Capital, and it's called capital stack. I'm going to show you how exactly we combine debt, equity, and sometimes creative tools like vendor take back financing to make deals work while protecting that car won't let me be great. Okay, I think it's done now. While protecting investors' funds and maximizing returns. So, what is capital stack? You can think of capital stack as a layered cake. So it shows who contributes what money to fund the purchase or development of a multifamily property. So the layers from most secure to least secure would typically look like this. Senior debt. So senior debt would be a bank loan or institutional lender. They have the priority. Now you have preferred equity. And then common equity would be our capital and investors' money. Lastly, sometimes in some cases we would look at VTB financing, and I'll explain that in a bit. So each layer comes with its own risk and reward profile, and structuring it the right way is what separates an average deal from a truly strategic one. I often say that deals aren't found, they are created. Now, let's start with debt. In multifamily, debt often covers about 60 to 75%, typically of the purchase price. This might be a conventional loan, a CMHC insured loan, which I'll talk to you guys a little bit more about that in another video. Or sometimes it's private debt if the asset needs, let's say, repositioning. So debt is cheaper than equity because lenders get paid first and the collateral reduce their risk. But it brings its own risk as well. So you have the interest rate exposure, especially in today's volatile environment. Next, you have the debt service coverage ratio. So lenders want proof that your NOI covers your debt payments comfortably. Lastly, amortization and call risk. Balloon payments can create challenges. So we underwrite conservatively, stress test rates, plan for vacancies, and ensure deals cash flow supports the debt and the investor's return. Now we have the equity, the ownership layer. Equity typically comes from two places: your own funds as sponsors, or your own funds, or outside investors like LP or JV partners. Equity holders take on higher risk. Unlike lenders, they only get paid after expenses and debt, but they also share the upside. That's the appreciation, the forced equity from renovations, and the cash flow distribution, and of course refinancing. They benefit from that as well. For sophisticated investors, understanding the capital stack helps you to know where you sit. Limited partners usually get preferred returns before GPs take or promote profit splits. Equity holders can vote on major decisions, while lenders just want timely payments. The key is aligning risk and reward transparently so everyone wins when the asset performs, and that's what we do here at Ellison Capital. Next, we have the VTB financing, or the creative edge, I call it. Now let's talk about something that shows sophistication in structuring deals. My favorite, vendor take back financing. Instead of paying the entire purchase price at closing, the seller agrees to carry a portion, often as a second mortgage behind the senior debt, the bank, right? Why do this? It reduces the cash we need to raise the equity. So often it's at better terms, lower interest rate or interest only payments. Also, it helps the seller defer capital gains tax. I'm not an accountant, so you would have to talk to your accountant about that. So it may be attractive to them. For example, purchase price is 5 million, senior debt 3.25 million, so that's 65%. VTB 500,000, that's 10%. Equity needed only 1.25 million instead of 1.75 million. That's 500,000 less to raise, improving investor returns and smoothing cash flow. But VTB requires trust, solid underwriting, and clear documentation to keep everyone happy and protected. Why this matters? Why do we break this down? Now, let's talk about why this matters and why do we break this down. Because capital stack is more than numbers. It's about balancing risk, reward, and alignment. Debt lenders want stable cash flow. Equity investors want upside, and VTBs can bridge the gap creatively. Understanding this helps us to build deals that survive downturns, attract the right partners, and deliver sustainable wealth over time. Now, I hope you found this video very helpful. If you found this video valuable, please make sure to subscribe to Ellison Capital TV. We share sophisticated strategies to structure multifamily deals, improve communities, and build lasting wealth. Drop a comment if you'd like me to do a real life walkthrough of one of our deals. And thank you for watching. See you at on the next video. Also, I am thinking about doing a checklist for you guys, a free checklist. It may be in this video description or the next one, but stay tuned for that. Thank you guys for watching and see you in the next one. Bye.